welcome back once again to Intelligent Investment Today, the podcast dedicated to all things value investment. In this episode, we're going to explore one of the foundational disciplines of traditional value investing: balance sheet analysis. Now, in modern markets, investors often spend enormous amounts of time focusing on stories, future growth, exciting technologies, and narratives about disruption and innovation. But for Benjamin Graham, the father of value investing, investment began somewhere far more grounded: the balance sheet. The hard financial reality of the business, its assets, its liabilities, its financial strength. Because Graham thought that before an investor should even think about future growth or optimistic projections, they should first start with a question that is far more simple. How financially secure is this company right now? And today we're going to explore balance sheet analysis through a distinctly Graham-style lens. Why financial strength mattered so much to him, what investors should actually look for inside a balance sheet, and why understanding a company's financial structure can often tell you far more than an exciting story ever will. So sit back, tune in, and let's get ready to go. Let's start with the very basics. A balance sheet is essentially a snapshot of a company's financial position at a specific moment in time. It shows what the business owns, what it owes, and the residual value belonging to shareholders. In its simplest form, the balance sheet follows one core equation: assets minus liabilities equals equity. Or put another way, what the company owns minus what it owes equals what belongs to the shareholders. Now, this may sound straightforward, simplistic even, but for Graham, this statement was absolutely fundamental. Because unlike market sentiment or speculative forecasts, balance sheets contain tangible financial information: cash, receivables, inventory, property, debt obligations, working capital. And Graham believed that intelligent investing should begin with facts rather than stories. One of the key reasons Graham focused so heavily on balance sheets was his deep concern with downside protection. Let's remember, Graham developed many of his ideas in the aftermath of the Great Depression. He saw businesses collapse, he saw speculation destroy wealth, and he became obsessed with one central principle: margin of safety. The idea that investors should protect themselves against error, uncertainty, and unexpected events. And a strong balance sheet was one of the clearest forms of protection available. A company with substantial cash reserves, low debt, and strong liquidity could survive difficult conditions far more easily than a heavily leveraged business. This mattered enormously to Graham, because he understood something many investors forget. A company does not fail because its story becomes less exciting. It fails ultimately because it runs out of money. Now, one of the first things Graham often examined was working capital. Working capital is simply current assets minus current liabilities. In other words, the liquid resources available to run the business after short-term obligations are covered. Current assets include things like cash, receivables, inventory, or assets expected to become cash relatively soon. Current liabilities include short-term debt, accounts payable, and obligations due within the near future. A positive working capital position suggests financial flexibility. A negative position may indicate stress or dependence on continued financing. Graham became famous for an approach known as net-net investing. This involved buying companies trading below their net current asset value. Essentially, he looked for situations where the market value of the company was lower than the value of its current assets minus all liabilities. And it's worth stopping and thinking how extraordinary that is. It means the market is sometimes pricing businesses so cheaply that investors could theoretically buy the company for less than its liquid assets were worth. And in many cases, Graham treated the fixed assets almost as a bonus. Now, these opportunities are far rarer today, but the principle remains important. Balance sheet strength creates a foundation of safety. Another major focus for Graham was debt, and this remains one of the most important aspects of balance sheet analysis today. It is worth pointing out that debt itself is not necessarily bad. It can help businesses expand, invest, and improve returns. But excessive debt introduces fragility. Because debt creates fixed obligations, interest payments, repayments, covenants. And during difficult periods, those obligations do not disappear simply because business conditions deteriorate. This is precisely why heavily indebted companies can very quickly become vulnerable during recessions or economic shocks. Even profitable businesses can collapse if liquidity dries up. Graham understood this deeply, which is why he strongly preferred conservatively financed businesses. Companies with manageable debt levels, strong interest coverage, and sufficient liquidity to survive difficult conditions. Because once a business becomes financially distressed, shareholders often discover how little protection they actually have. This ties directly into another critical concept: the hierarchy of claims. As we discussed in previous episodes, shareholders sit at the bottom of the capital structure. If a company fails, creditors are paid first. Bondholders, banks, secured lenders. Only after those obligations are satisfied do shareholders receive anything. And in many bankruptcies, there is little left. This is why Graham cared so much about asset values and conservative financing. He wanted businesses with enough financial strength to reduce the probability of permanent capital loss. Again, his focus was not merely on upside, it was on survival. Now, one area where balance sheet analysis becomes particularly important is liquidity. Liquidity in this sense refers to a company's ability to meet short-term obligations. Can it pay its bills? Can it service its debt? Can it survive temporary disruptions? A company may appear profitable on paper, but still experience liquidity problems if cash flow becomes constrained. Cash provides flexibility and resilience. It allows businesses to survive downturns without relying excessively on external financing. And during crises, strong liquidity can become a major competitive advantage. Companies with cash can continue investing, while weaker competitors are forced to retrench. They can acquire assets cheaply, retain employees, and maintain operations under pressure. So while investors often focus heavily on earnings, Graham constantly reminded investors to examine financial strength underneath those earnings. Because earnings can fluctuate, but solvency is existential. Another fascinating aspect of Graham's style analysis is the emphasis on tangible value. Modern markets often place enormous value on intangible assets. Things like brands, software, networks, intellectual property. And while these things can certainly be valuable, Graham preferred things that could be measured more conservatively. Hard assets, liquid assets, observable financial resources. This does not mean he ignored business quality, but he was cautious about relying too heavily on uncertain assumptions. And this cautious mindset is one reason his approach has remained influential for decades. Because investing ultimately involves uncertainty, and balance sheet analysis provides a way to anchor decisions in financial reality. Now, it's important to recognise that balance sheet analysis alone is not sufficient. A strong balance sheet does not automatically make a company a good investment. A business may have large assets but poor profitability, or indeed weak long-term prospects. Likewise, some exceptional businesses operate successfully with relatively asset-light models. So Graham-style investing is not about blindly buying low price-to-book companies, but it is about understanding financial resilience, and the balance sheet provides insight into risk, into stability, into survivability, and when combined with earnings power and sensible valuation, it becomes a powerful analytical tool. There is, you will not be surprised to hear, also a psychological advantage to balance sheet analysis. It encourages discipline, objectivity, and skepticism. In speculative markets, investors are often drawn to exciting narratives, promises of future disruption, exponential growth. But Graham encouraged investors to remain grounded, to ask, what resources does this company actually have? What obligations does it face? How strong is its financial position? And importantly, what happens if things go wrong? Because eventually, reality matters, cash flows matter, debt obligations matter, and balance sheet weakness tends to reveal itself brutally during difficult periods. Another area Graham paid close attention to was dilution. Companies under financial pressure sometimes issue additional shares to raise capital. Now, this may stabilise the business temporarily, but it can also reduce ownership percentage of existing shareholders. In other words, even if the company survives, shareholders may emerge owning a much smaller portion of the business. This is another reason why financial strength matters so much. Weak balance sheets can force management into difficult decisions during downturns, and shareholders often bear the consequences. So, intelligent investors must think not only about growth, but about resilience under stress. So, as we get to the end of this discussion, it's worth reflecting on why balance sheet analysis remains so important today. Markets evolve, industries change, technologies advance, but financial reality never disappears. Businesses still require liquidity, debt still creates obligations, and strong balance sheets still provide resilience during uncertainty. Benjamin Graham understood this deeply, which is why he treated balance sheet analysis not as a secondary exercise, but as one of the foundations of intelligent investing. Because before investors become excited about growth, or narratives, or future possibilities, they should first understand the financial structure supporting the business underneath. That brings us to the end of this edition of Intelligent Investment today. A look at balance sheet analysis through the eyes of Benjamin Graham, and a reminder that investing ultimately begins with understanding financial reality, not market excitement. I'm David Coombs. This has been Intelligent Investment today. Until next time, stay safe and happy investing.